It's 2025, and the IRS is officially done playing games with crypto. They've unleashed what can only be described as the most aggressive, data driven crypto tax crackdown in history. The brutal truth is, most investors are completely exposed, walking straight into a tax minefield that could vaporize a huge portion of their gains. But what if I told you that while everyone else is panicking, there are completely legal, ethical, and powerful ways to navigate this new landscape? What if you could sidestep the most dangerous new reporting traps and protect your portfolio using the exact same strategies the ultra wealthy have used for decades? In this video, this isn't about vague theories. I'm pulling back the curtain to show you the exact four-part strategy I am personally using to legally minimize my crypto tax bill in 2025. This is how I'm turning what the IRS intended as a trap into a strategic advantage. So, what makes 2025 such a big deal? Why the sudden urgency? It's not just about the IRS having more auditors. It's about a fundamental shift in their strategy, from passive enforcement to aggressive automated surveillance. For years, the IRS has been collecting data through methods like the John Doe summons, forcing exchanges like Coinbase and Kraken to hand over user data. They've been quietly building profiles on millions of investors. But in 2025, that data collection goes into overdrive, and it's all centered around one deceptively simple-looking new document: Form 1099-DA. Starting January 1st, 2025, any entity defined as a broker, a terrifyingly broad term including centralized exchanges like Coinbase and Kraken, is now required to report your digital asset sales directly to the IRS on this new form. Now, on the surface, this sounds helpful, right? Like the 1099B you get for stocks. Wrong. It's a Trojan horse. It looks like a gift, but it's designed to create chaos for the unprepared. Now, it's important to know that for 2025, Congress has nullified these specific reporting rules for DeFi platforms, and certain transactions involving NFTs and some stablecoins are also deferred for now. But for anyone using a major centralized exchange, you need to be aware of three specific built-in traps that I am meticulously planning for right now. First is the cost basis gap. For the tax year 2025, the Form 1099-DA you'll get in early 2026 will report your gross proceeds to the IRS, but for many transactions, it won't include your cost basis. Let's make that crystal clear. Say you sell 2 Bitcoin for $100,000. You bought them for $90,000, so your actual profit is only $100,000, $10,000. But the 1099-DA that goes to the IRS will just show $100,000 in gross proceeds. The IRS computers will flag a $100,000 transaction, and the entire burden of proving you only made $10,000 falls on you. If your records are sloppy, the IRS's default position can be to assume a cost basis of zero, and you'll get a tax bill on the full $100,000. You're now guilty until proven innocent. The second trap is the mandatory wallet-by-wallet accounting method. Before 2025, you could use a universal accounting method, looking at your entire crypto portfolio as one big pool. As of January 1st, 2025, for most investors, that's gone. The IRS now mandates that you must track your cost basis on a wallet-by-wallet or exchange-by-exchange basis. Imagine you have 10 bank accounts. The old way was like looking at your total net worth across all 10. The new way is like being legally required to balance 10 separate checkbooks for every single transaction and never letting them mix. If you bought Bitcoin on Coinbase, sent it to a ledger, then sent it to a DeFi protocol, you now have a chain of transactions across 3 separate wallets that must be tracked independently. For active crypto users, this is a logistical nightmare. The third trap is a mix of timing and delivery mismatches. The new rules state that brokers must report transactions using Coordinated Universal Time, or UTC. Imagine it's New Year's Eve in California. At 10 p.m. on December 31st, you sell a coin to harvest a tax loss. But in UTC, it's already January 1st of the next year. Your records show a 2025 sale, but the 1099-DA will report it as a 2026 transaction. This mismatch is an automatic audit red flag. To make it worse, the IRS has granted transitional relief, allowing brokers to be up to a year late issuing these new forms for 2025. You could file your taxes in April, only to get a form in June that contradicts what you filed. These traps aren't accidents, they are features of a system designed to catch you off guard, which is why the first part of my strategy isn't some clever loophole, but building a defense that makes these traps irrelevant. Before we dive in, the obligatory but critical disclaimer: I am not a CPA, attorney, or financial advisor. This video is just me sharing my personal journey, research, and the strategies I'm using for my own portfolio after talking with my own pros. This is for educational purposes only. You absolutely must consult with your own qualified professionals. The stakes are way too high not to get personalized advice. So, facing this mess, where do you even start? You start with the least glamorous but most powerful strategy in this whole video: building a bulletproof system for your records. A simple spreadsheet isn't going to cut it anymore. That's like taking a rowboat into a hurricane. To survive the wallet by wallet mandate, you need a system. Here's my 5-step process for creating an audit proof defense. Step 1: I chose my tool, a dedicated crypto tax software. This is no longer optional. Manually tracking everything is a recipe for disaster. I won't endorse a specific platform, but I'll tell you the non-negotiable features I looked for. First, robust API integration with every major exchange I use to automatically pull my trade history. Second, CSV file import capabilities for exchanges with bad APIs, or more importantly, for historical data from defunct exchanges like FTX. Third, and this is crucial for 2025, it had to have powerful DeFi and NFT tracking and the ability to tag and separate transactions by wallet. If the software can't tell my ledger from my MetaMask, it's useless. Step 2, I conducted the Great Wallet Roundup. This was a pain, but it was essential. I sat down and made a master list of every single place I've ever held crypto: centralized exchanges, Coinbase, Binance, Kraken, etc., hot wallets, every MetaMask, Phantom, and Exodus wallet I've made, cold wallets, my Ledger, and Trezor devices. Blockchain addresses, specific addresses on Ethereum, Solana, and others where I might have gotten airdrops. In my tax software, I created a corresponding wallet for each one. This lays the groundwork for the wallet by wallet accounting. Step 3, I connected everything: the API and CSV grind. With my list ready, I went into my software and started connecting. For the big exchanges, I created read-only API keys and linked them. For my DeFi wallets, I found my public addresses and added them so the software could scan the blockchain. For older data, I hunted down CSV export functions and manually uploaded them. This took days, not hours. It was tedious, but that's the price of security. Step 4, I began the manual grind: tagging and categorizing. This is what separates the prepared from the panicked. No software is perfect. It will pull in thousands of transactions it doesn't understand and label them uncategorized. It's your job to go through them one by one and tell the software what they are. This is where you prepare for an audit: transfers. When I send crypto from Coinbase to my ledger, that's just a transfer. It's not a taxable sale. I have to label it that way, or the software might see it as a disposal and create a phantom capital gain. Staking rewards. When I get staking rewards, that is taxable income at the fair market value on the day I got it. I tag every reward as staking, so it's counted as income and sets the cost basis for those new coins. Airdrops. An airdrop is also taxable income at its value on the day of receipt. I tag it as airdrop. Spends. That time I bought coffee with crypto, that was a taxable sale of a capital asset. I have to find that transaction and mark it as a spend. DeFi actions. This gets complex. Adding liquidity to Uniswap, lending on Aave. Each of these steps has potential tax consequences. I meticulously tag them as liquidity in, liquidity out, or lending to make sure they're treated right. This manual tagging is the difference between a guess and an ironclad record. Step 5, I perform the reconciliation audit. Once everything is tagged, I do a final check. I have the software tell me the final balance of every asset in every wallet. Then I manually open that exchange account or check that wallet on a blockchain explorer and compare. If my software says I have 1.5 ETH in my ledger, but I see 1.48 ETH, I have to play detective and find that missing 0.02 ETH. Was it a gas fee, a small swap I missed? This ensures my records perfectly match reality. Finally, I take one last step. I go to the IRS website and request my wage and income transcript. This shows me exactly what data the IRS already has on me. It's like seeing your opponent's cards before you play. I compare the 1099s the IRS has with my own records to spot discrepancies before I file. This defensive foundation is the most important part of my entire strategy. Everything else is built on it. With our defense fortified, we can stop playing scared and start playing smart. Time to go on offense. These are the strategies I use not just to report my taxes correctly, but to actively and legally reduce my final tax bill. Strategy 1, I'm using strategic tax loss harvesting, exploiting a critical but temporary loophole. Tax loss harvesting is a classic move. You sell assets at a loss to realize that loss, which can then offset your capital gains. If you have more losses than gains, you can even deduct up to $3,000 against your ordinary income. With stocks, this is limited by the wash sale rule, which says you can't claim a loss if you buy the same or a substantially identical security within 30 days. Here's the key. As of right now, for tax year 2025, the IRS classifies crypto as property, not a security. So the wash sale rule does not apply. I can sell Bitcoin at a loss, harvest that loss for my taxes, and then if I want, buy that Bitcoin right back minutes later. Let's say I have a $50,000 unrealized gain in Ethereum and a $20,000 unrealized loss in Solana. If I just sell my Ethereum, I have a $50,000 gain to pay taxes on. Instead, I can sell my Solana, harvesting that $20,000 loss. Then I sell my Ethereum. Now I only have to pay tax on $30,000 of profit, not $50,000. And if I'm still bullish on Solana, I can buy it right back. But be warned, this is a loophole and the government knows it. The Biden administration's 2025 budget proposal explicitly includes applying wash sale rules to digital assets. While it hasn't passed and likely wouldn't be retroactive, the clock is ticking on this strategy. I'm using it for 2025, but I'm watching legislative updates like a hawk. Strategy 2, I am mastering cost basis methods, choosing between FIFO and specific ID. This is one of the most underrated but powerful tools an investor has. When you sell crypto, the IRS needs to know which specific coins you sold. By default, they use FIFO, or first in, first out. First in, first out assumes you're selling the very first coins you ever bought. In a bull market, this is usually the worst case scenario. Let's say I bought Bitcoin 3 times, 2018, 1 BTC at $10,000 2021, 1 BTC at $50,000 2024, 1 BTC at $30,000. It's 2025. Bitcoin is $60,000 and I sell 1 BTC. With FIFO, the IRS assumes I sold the 2018 coin. My taxable gain is a massive $50,000, $60,000 minus $10,000. But I don't have to use FIFO. The rules let me use specific identification, specific ID, where I can choose exactly which Bitcoin I want to sell. To do this, you need records that prove you identified the specific coin at or before the time of sale. This is why my software is so critical. Using my records, I can choose to sell the Bitcoin I bought in 2021. My taxable gain is now only $10,000, $60,000 minus $50,000. By simply choosing which coin to sell, I have direct control over my tax bill. That's a $40,000 difference. This isn't a loophole, it's an IRS sanctioned method for any investor with the records to back it up. I know this is getting complex, and that's the point. The IRS is making it this way on purpose. We've covered my defense and offense, but next, we're going into the game-changing structures the wealthy use. To help you keep this all straight, I've put together a free PDF, the 2025 Crypto Tax Survival Checklist. It summarizes the record-keeping steps, first in, first out versus, specific ID, and the 1099-DA traps. It's yours for free when you sign up for my weekly newsletter at the link in the description. All right, let's get into the advanced playbook. Everything so far is about playing the game the IRS has set up. This section is about changing the game entirely. These are more complex, long-term strategies that can lead to tax-deferred or even tax-free growth. They require professional help, but they can be life-changing. Advanced strategy. 1. The crypto self-directed IRA, STIRA, building a tax-free war chest. One of the biggest drains on a successful investment is capital gains tax. A self-directed IRA, SDIRA, lets you create a tax-sheltered bubble around some of your crypto. Here's the idea. You work with a specialized custodian to open an SDIRA that can hold alternative assets like crypto. You fund this IRA and use it to buy crypto directly within the account. There are 2 main types. The traditional SDIRA. Your contributions might be tax deductible and your crypto grows tax deferred. You can trade inside the IRA without paying capital gains on each trade. You only pay income tax when you take the money out in retirement. The Roth SDIRA. This is the holy grail. You contribute with after tax money, but your assets grow 100% tax free. Imagine the power of a Roth S-DIRA. You invest $10,000 in a small project through your Roth S-DIRA. 10 years later, it's worth $1 million. If this were in a normal account, selling would trigger a massive tax bill. But inside your Roth S-DIRA, you can sell, and that $1 million is yours to withdraw in retirement, completely tax free. The hurdles? This isn't for day trading. SDIRAs require a special custodian, fees are higher, and there are annual contribution limits. You also can't just send crypto from your personal wallet. The custodian has to handle all transactions, but for a portion of my portfolio with long-term potential, the tax savings are too huge to ignore. Advanced Strategy 2, the Charitable Remainder Trust, CRT, the ultimate exit strategy for massive gains. This is the big one. This is for those with life-changing gains, 6, 7, or even 8 figures who are staring down a soul-crushing tax bill. I think of a Charitable Remainder Trust, CRT, as creating my own personal tax-free zone. It sounds complex, but here's the process. The problem: I have $2 million of Bitcoin that I bought for only $50,000. If I sell, I have a $1,950,000 capital gain, leading to a federal tax bill of nearly $400,000 plus state taxes. A huge chunk of my profit is gone. The solution: donation? Instead of selling, I work with an attorney to create a CRT. I then donate the $2 million of Bitcoin directly to the trust. This transfer is not a taxable event. I also get a significant charitable tax deduction on my income taxes for that year. The sale, tax-free. The trust, which is tax-exempt, sells the Bitcoin. And because it's a tax-exempt entity, it pays zero capital gains tax. The full $2 million in cash is now inside my trust. The income stream: the trust invests that $2 million, and per the rules I set, it pays me a steady income stream for a set number of years, or even for life. I get to enjoy the proceeds of my investment over time. The remainder: when the trust term ends, whatever is left, the remainder, is donated to the charities I designated at the start. To recap the benefits: I avoid the massive upfront capital gains tax. I get an immediate income tax deduction. I convert a volatile asset into a stable income stream. And I leave a legacy to a cause I care about. The downsides: this is an advanced legal tool. It's irrevocable. Once the money is in, you can't take it back. It's also expensive to set up, so it's generally only for those with very large gains. But for those it fits, it's arguably the most powerful tax mitigation tool that exists. Finally, I want to talk about psychology. The IRS isn't just setting reporting traps. It's setting compliance traps designed to make panicked investors incriminate themselves. The best example is IRS Letter 6174. People are getting this real letter in the mail. It says the IRS has information suggesting you have unreported crypto transactions and urges you to file amended returns. To an anxious investor who knows they might have made mistakes, this seems like an olive branch. It is a massive trap. Here's why. The letter deliberately leaves out crucial information, especially about foreign accounts. Many crypto investors use non-US exchanges like Binance. Any foreign financial account with over $10,000 in it at any point during the year must be reported on a separate form, the FBAR. If you get letter 6174, panic and file an amended return but fail to also file your missing FBARs for that Binance account, you've made a catastrophic error. You just admitted to the IRS you had unreported income while handing them proof you failed to disclose your foreign accounts. The penalties for FBAR violations are draconian, sometimes far greater than the original tax you owed. You've walked right into their trap. The lesson is profound. If you have prior year compliance issues, or if you get any mail from the IRS, the most important part of my strategy is this: do not act alone. Do not respond. Do not call the number. Your first and only move should be to engage a qualified tax professional, a tax attorney or CPA with deep experience in crypto and international tax. They will know how to represent you and ensure you don't accidentally make things infinitely worse. The crypto tax world changed forever in 2025. The era of best effort reporting is over, but this doesn't have to be a reason for fear. To recap my personal 4-part strategy: first, I built an indestructible defense. I implemented a bulletproof wallet-by-wallet record-keeping system using dedicated software and obsessive reconciliation, making me immune to the new Form 1999-DA traps. Second, I've gone on the offensive. I'm actively using legal strategies like tax loss harvesting and specific ID cost basis accounting to ethically reduce my taxable gains. Third, I'm planning for the long term. I'm exploring game changing structures like self directed individual retirement accounts and charitable remainder trusts to shelter my most significant gains from taxes. And fourth, I am remaining vigilant. I understand the IRS's psychological tactics and know that if I ever have compliance issues, my only move is to bring in a professional team. The IRS wants you to be intimidated and confused. They're counting on it. But by understanding these rules, building a solid foundation, and planning ahead, you shift the dynamic. You move from a position of fear to a position of control. If this video helped bring some clarity to a very confusing topic, the best way to say thank you is to subscribe and hit the notification bell. I'm constantly researching this space and will be sharing updates as they happen. And as a next step, I highly recommend you check out the video on my screen now, a deep dive into related topic, e.g. the top 3 crypto tax software platforms for 2025, where I compare the features you'll need to implement this system. Thank you for watching and stay strategic.